Thank you, Junaid. And up next, a very familiar face will be hosting a panel on the race to refinance with key guests from CANSTAR, RFI and Athena. Looking forward to that panel. And after that, we'll be going straight into the lunch break. So I will see you after the lunch break. Thank you, ladies and gentlemen. We are up for this next panel session, which is all about the race to refinance. And joining me on this panel session, we have three great guests. We have Kate Wilson from RFI Group. She's Deputy General Manager and Research Director. We have Nathan Walsh, who is co-founder and CEO of Athena Home Loans, and Stephen Mickenbecker, Group Executive for CANSTAR in the Financial Services Department. Thank you very much for joining me all. Just for our audience, tell us a little bit about what you do, just to give a bit of context. Kate, why don't you start us off?
Jules. Hi everyone, I'm Kate Wilson. So as Julien said, I'm the Research Director and Deputy GM at RFI Group. So my role is really managing our research team, working with our clients. Athena is one of them. So working with our clients alongside my team to make sure that we're delivering insights back to the market on what's happening, what customers are thinking and feeling.
Fantastic. Nathan?
Yeah, so co-founder and CEO for Athena. So we're a residential mortgage lender focused on digital and direct. And this month we're 2 years from our launch to market.
Excellent. Congratulations.
Thank you.
Stephen.
Good afternoon. I'm Group Executive Financial Services at CANSTAR. Now, CANSTAR rates and researches and publishes a free website visited by 1 million people every month. And deals with 40 or 50 finance verticals, virtually everything in finance. I'm sort of the finance eminence, the grey hair of the group, plus chief spokesperson, and so all things financial services, really.
Fantastic. And that kind of, I guess, even your introductions encapsulates one of the first sort of unique things about this panel that I think, and the first sort of topic I would like to get into with the three of you, which is looking at trends that we've never seen before. And I think obviously the words like unprecedented and things like that were thrown around a lot and probably still are being thrown around. But the three of you have access to very unique sets of data within your organizations. You see changes in traffic. If you've got 1 million people coming to your website a month, that is a huge number. Kate, obviously working with data and insights at RFI Group, and Nathan, being a business that went from 0 customers to obviously being around for 2 years and growing quite fast, you would be seeing very unique sets of data within your organization. So the first thing I would like to do, and maybe we'll start with you, Nathan, is sort of reflect on what are the most interesting things that you've seen in the last 12 months, given the fact that we've gone through, I guess, what is a very interesting time, and obviously refinancing has become a bit of a priority for consumers. What have you seen as sort of emerging trends within the data in your organisation?
Well, it's certainly not hard to kind of point out interesting trends when you look to the last 12 months. It's certainly been some fairly unprecedented times. So maybe talk about some things that we think of as new, and maybe a few trends which are just, long-standing but accelerated over a period of time. And maybe the first one is, clearly as an industry, mortgage lenders should be really proud of the support that has been provided to the community, really getting through the whole COVID, epidemic. And I think it's really quite exciting as some of the numbers are coming out, even over just the most recent weeks, of just how quickly that has rolled off. And so, where things were sitting in June in terms of folks in hardship versus where they are today, just the really broad improvement that we've seen. I think it's going to be interesting to see what that does for expectations of customers around their lending. So expectations of flexibility when you think about things like payment holidays and the ability to get in and out of commitments. And so I think that's probably one of those big dimensions. The second has been, not surprisingly, with so much of the community in lockdown at various times, just that acceleration of digital, which has been in so many parts of people's lives, but it really has hit the home loans game in a big way as well. And we've certainly benefited from that as a specialist digital lender. We've now passed $2 billion of settled loans in our first 2 years, and really seeing, when you look to the customers who are making that switch that's not just a group of early adopters who've been playing in that space. The typical Athena customer, their last loan was from a major legacy lender going via a broker channel. And so you're really seeing that broad willingness to migrate channels, within the context of this, just as you're seeing for online shopping and so many other categories. But probably the other one, which I'd love to maybe focus a little bit more on, is just the market dynamics shifting so significantly. So the RBA's subsidy, particularly to the major banks via the $200 billion TFF facility, translating into some very major share shifts towards major lenders. So, I think that the New South Wales Land Registry numbers are probably particularly interesting and timely. Over the 12 months to December 2020, the major banks grew refinance in volumes by nearly 26%. And then other sectors all suffered, non-bank lenders, for example, down by 31% over that period of time. So really where you see regulators put their finger heavily on the competitive landscape, that can very much tilt, what's going on in the broader market. And probably the area, no surprises, where that's had the biggest impact is just the really staggering growth in terms of fixed rate products, growing to a much larger part of the market. So, typically over the long term, 10 to 15% of flow and really being at the majority of flow today. And so it just will be interesting around the extent to which that does become a sort of a more permanent change in the landscape of not just, expectations for loans. And we'd say that's not actually all been to customers' best interest. When you look at so many of those loans, the scale of gap between the headline rate and the comparison rate on these products, is pretty extraordinary. When you're sort of seeing a headline rate that starts with a 1, but a comparison rate that's well above even what backbook pricing would be in the market once you take into account fees, converting to very high standard variable rates. And those products which, despite that very high total cost of credit, are being marketed as sort of lowest rate ever. And so I think as an industry, that gets really interesting. It's not just banking on customer inertia, the idea that customers won't just get that benefit in that first, 1, 2, 3 years, but, banking that they will actually stay with these products over the long term. It's actually, in our view, banking on regulatory inertia as well. The idea that this won't be seen as misleading customers at scale in the market. And clearly not all fixed rate products are in that category, but we really are calling out those where the gap between the headline rate that's been really focused on in marketing and the actual true cost of the loan as represented by the comparison rate is just so very stark. And so, I think there are probably a couple of the really big trends, but clearly this is a fascinating conversation and lots of different threads that you could pull on here.
Definitely. And that certainly relates to, I guess, the difference between the headline rate and the comparison rate leads to, I guess, differing views by consumers, and they end up reacting in certain ways because they potentially don't understand the difference between the two. So they seek help outside of going directly to a lender as well. And Kate, you could probably reflect on some interesting trends in the last 12 months that sort of touch on some of the points that Nathan made regarding the differences between advertised rate and headline rate, and just the need for a consumer to be looking for more pieces of information, for more clarity on what products are out there.
Yeah, I think that's a good point on the difference between the two. Consumers do get confused by that. The customers that we survey always say that rate is important to them, but we know that they have sometimes a bit of a poor understanding about the difference between the rates that are available to them. And there's also, and I'm sure we'll get onto this later, but so many different offers in the market at the moment, so much competition, and the likes of incentives as well. So a customer balancing up how that incentive plays out compared to a headline rate or a comparison rate, I think does get quite confusing. And I think a lot of the time we see customers relying on brokers to really help them through that, and potentially there's more, maybe more room for lenders and for customers to be thinking about how else they can understand those differences and how they can get the best product for their needs. I think in addition to just the low rate environment that we're in at the moment and the changes that brings and the changes in competition, the other key theme that I'd bring up, and I think very much predates COVID, but the increase in multi-banking that we're seeing and the decline in customer loyalty. So we've seen this in our data for the last couple of years. We know that customers are using more and more banks, and increasingly customers are trying to at least choose a product that best suits their needs and not necessarily the product that's offered by their main bank. So customers are getting savvier, they are becoming more price sensitive, which probably points to how important having that education piece is for customers so they can make that decision correctly and with the right information. And mortgages is actually one of the places where we see that happening quite quickly. And I think brokers have played a really big role in that in the past. Customers really relying on brokers to help them drive their decision making, trusting brokers, trusting the information they're giving them in terms of choosing from a range of providers. But increasingly we're seeing that in every element of banking. Customers are just more open to a wider range of providers, don't necessarily want everything in one place. And I think that will continue to have a big impact on the market going forward as well, especially with competition where it is at the moment.
Yeah, very true. And Stephen, the interesting side of CANSTAR and the sort of information that you're seeing is no doubt there is an element of the last 12 months where you have more people with more time to be looking at their financial services products, reevaluating them. And so have you seen some interesting trends in your data, particularly when looking at mortgages and mortgage shopping that fall into a category for you where, oh, these are people that normally are too busy to be looking at refinancing? I mean, what are some of the interesting trends that you've seen?
Yeah, there certainly have been very interesting trends over the period. When COVID started, people went into very defensive mode, and frankly, our traffic didn't fall, but it became defensive traffic. So people were searching repayment freezes and holidays, etc. They were searching things about JobKeeper, all of those defensive things. About 4 or 5 months ago, though, it all changed, and suddenly the traffic started just escalating dramatically and moved back to very high intent, high purchase intent traffic. Now, it was a startling move, and we saw a recovery towards pre-COVID levels, and it's accelerating now, of course, as the market heats up. We see some really interesting things that are going on in the market as well in terms of the mix of traffic and what people are doing on the website. First home buyers, now they're obviously they're not refinances, but the dominance in the market is amazing. They're really moving into the market big time, way ahead of long-term trend. Likewise, construction loans. Now again, not first home, not refinances, but construction loans way out of proportion to the normal level. But as Nathan points out, fixed rates have absolutely ballooned. And it's an interesting point that it's not actually consumer driven. Now, I think that probably is part of the point that, the point Nathan's making goes partway into that. It's not a consumer driven. People haven't said fixed rate suits me better. They've said, how can I get a very good rate at the bank I'm at currently? And given that 70% odd of people are still with the big four banks, that's where they're competing. They have the benefit of that term funding facility for the next few months, and certainly they want to write a lot of loans on fixed rate and put their foot on that business for the next 3 or 4 or 5 years. So it's supplier driven, but we're seeing it's a massive migration to fixed rate. The other thing we're seeing is that refinance normally is kind of the number 2 or 3 category on our website. You know, we divide up our traffic into first home buyers, investors, refinance, second home, those style of categories. Refinance is very much at the top of the pile at the moment, and it's hot. Everyone's after refinance right now. They're seeing the amazing rates on the market. CANSTAR lists 138 loans that start with a 1. Now, who would have thought? And so they're seeing that and they're saying, look, I've got to do something about this. I can see that my average rate isn't that great. I just want to talk a little bit about that point that was made about fixed rates. Now, one, I've said, yes, it's supplier driven. The other issue is that whether you take fixed rate or not, whether you take fixed rate or variable, you can't just say, I'll wait 4 or 5 or 6 years to do something about it, because the way the industry's been over the last 10 or 15 years, new borrowers get a much better deal than existing borrowers. So whether you're in fixed rate, going to standard variable, who borrows at standard variable? Well, no one except coming off fixed. When you borrow on fixed, you have just as much need to revisit your repayment as if you borrow on variable. The same problem. If you leave your loan 3 years on a variable rate, you will not be on a good deal. Chances are, if you borrowed 3 or 5 years ago or something, you're on one of the big banks' package rates, and you'll be on 3.5, 3.6%. Now that's a terrible rate in today's market. So whether it's fixed with a high comparison rate or whether it's variable today at a reasonable rate, you have to revisit and reset your loan.
Excellent. And that sort of really goes to the next point, the next topic around shopping. I mean, we're four people that work within the banking financial services industry. How does a consumer drum up the motivation to run that steeplechase? It's difficult to do. But what are the sort of behaviours that you can count on? Kate, you mentioned that you can count on certain elements of the market, not necessarily understanding the rate, but what are the sort of other things you can count on from your customers? I guess, Nathan, you would also be able to count on certain things from your customers about their behaviour. But Kate, what can you count on from a borrowing customer, especially a refinancing customer, from their knowledge, from their skills, and their behaviour?
Yeah, when I was thinking about this, I was thinking about the fact that just by default, refinancers are a savvier customer than a first-home buyer, someone who's coming into the market for the first time. They've been through this before, and all of our data shows that a customer who's been through that application process before is more confident. They're more likely to be willing to refinance direct and online. They're more likely to be looking for a better rate, so they're very rate driven, and they're more likely to know what they want as well. So while a first-home buyer might not understand key features, they might not know what an offset account is, for example, a refinancer has a very good understanding of, or a much better understanding at least, of what it is they're looking for. So they do tend to be a savvier customer. They do tend to be more rate focused. I think the other point is they're going to be a more fickle customer and a harder customer perhaps to hold on to longer term, by nature of the fact these are customers who have switched. And if you've been through that switching process, it becomes demystified for you. It's not as hard as you think it is. So if you've got a better deal by refinancing after 3 years, there's no reason why you wouldn't do it again, I would imagine. And again, we see that in other banking products as well. Customers who've been through the pain of switching are more willing to go through it again if they perceive there is enough value in the market for them to go through that process.
Excellent. And Nathan, there are elements of your customer base that you would be detecting certain behaviours, certain attitudes. How have you found it? What can you count on from your customers?
Yeah, so look, I think probably I'd start with the points that Kate made about the real differences around confidence from first-home buyer versus refi. I think that is a very important point. People often assume digital platforms, are skew very young, but in fact, it's actually people who've often gone through the financing process before, or those who feel most confident to use those components. What we'd sort of call out is it is a much simpler scenario for many consumers because you're not worried at the same time of purchasing the property and all of the things that go with that. For a refinance, it's a much more single-minded. I've got a goal because I can get savings. I've got a goal because the service I'm getting just isn't there. I've got a goal because my needs may have changed from the product I originally got. The underpinning that, and again, coming back to Stephen's point about the front book, back book, so the loyalty tax, it is extraordinary just how much more, how much that has increased. I mean, when you look at the RBA's numbers there, where over the last 18 months, sort of for a principal and interest on an Occupy loan, the market average has gone from roughly 30 basis point gap to now more like 50 basis points. And when you sort of think about if that gap was to persist over the life of a loan over, say, 25 years, that would be equating to about $35,000 in savings. So these are very large numbers. The gap's actually a little bit bigger for investor segments as well. And so the behaviours that we see is probably, first off, in many cases, consumers underappreciate how the compounding impact of those percentage differences over many years, over an average mortgage, $450,000. So we'll have consumer discussions where you'll talk about it being a 0.5% difference. They'll think that's very small. And then you actually calculate that, and that translating into tens of thousands of dollars of savings over a period of time. And so I think, again, the industry probably hasn't served consumers well, where both comparison rate itself feeling like a confusing concept, but equally just percentage differences really can underplay in many consumers' minds just the savings involved. And then the other dimension is even where there are tens of thousands of dollars of savings, people are really busy, and it's very easy when you don't have the catalyzing event of a purchase to sort of have an intent to say, yeah, I should probably refi, but it's very easy to put that off over long periods of time. And when you think about, exclude out the home purchase scenarios and think about the flow of refinance activities just relative to the $1.7 trillion of home loans out there, it is still, people are often deferring for many, many years doing a purchase, even though they could have these big savings. So yes, there are absolutely consumers who are religiously going back and looking at CANSTAR and finding the right rate and moving quickly. But for everyone who's in that camp, there are many consumers who really aren't taking advantage of the opportunities out there. And I think that's probably where people are underappreciating the process that they may have gone through a few years ago with sort of that really painful paper-based processes, really moving to a world where this can be just surprisingly simple to step through, provide data, and particularly as things like open banking and other components, become more widely adopted and accessible, we get to the point where, people can underappreciate the value and possibly not recognize just how much easier it was than maybe when they've previously experienced those components. What we should sort of proudly call out is this is an opportunity for the industry to think about things differently. I mean, it is not inevitable that you should pay a loyalty tax, so we are proudly a lender who is zero loyalty tax. Our existing customers never pay more than new customers on a like-for-like loan. That's simply not this idea that we're going to abuse the inertia in the category to take advantage of customers when they're not looking. And then equally, our Accelerates product, where we dynamically price on the LVR. So as you pay down your loan, your rate comes down too. And so really you become a better customer, a lower risk customer as you pay down your loan, and that's a reward that should go to you. And so this idea that where they go high, we go low. And so I just think that's a real opportunity for the industry to challenge some of these conventions that just simply don't serve customers well.
Yeah, I think that's something that we'll touch on in a moment. Just those challenges to convention that are beginning to be challenged by the likes of Athena and a few other lenders. But back to you, Stephen. What do you think drives mortgage shopping? And I use mortgage shopping in particular because, I mean, a lot of institutions call it home buying, but when you're talking about refinancing, you are shopping. So what do you think really drives shopping? Is it, I guess, a different realization that it's just a marketing cue that has triggered someone to do it? What have you found that's been quite interesting from the customers that come through the CANSTAR platform? What are they clicking on when they're looking to refinance? What are they paying attention to?
Yeah, good question, because it changed over the period of COVID. During COVID, they were looking at a lot of big bank rates and the rate that they were probably on today. Now they're looking at the lower rates in the market, so they can sort the website that way. And they're looking at low rates in the market. Now, it's not surprising because with all of those loans around 2%, that makes a massive difference. And we get to RBA Day, and every time we get to RBA Day, we talk about rates around 2% and our traffic spikes, as you'd expect. It's the difference in rate clearly that is the driver. And frankly, I think the whole loyalty tax concept underrates the difference. I wouldn't get out of bed for 0.3% potentially. Well, I would, but plenty of people would not get out of bed for 0.3%. That's back book versus new book. It's an average, and averages tell all sorts of lies, unfortunately, because there are a lot of people who are out there who have not renegotiated their loan in 10 years, and they're not paying 3.3%, 3.6%. They're paying, they're not paying the average. They're paying a much bigger number. So it's probably 3.6 to 3.8% on a package loan. And then you compare that with the new book. Well, you're comparing it again with an average. You compare it with the best. Average isn't good enough anymore. The average loan is 3.3%. The better rates on the market, the rates we should be benchmarking by are 2%. That's where people should be going with this, 2%, not the average. And comparing an old average with a new average doesn't help. That goes to loyalty on average, but it doesn't go to where the opportunity is. The opportunity is to shop around and get a great rate. And people have to understand that and not be beguiled into thinking it's 0.3% or big deal. Because it is a big deal. It's a much bigger deal than that. It's 3.3 compared to 2, and that's 1.3%. That's a big difference. So I call it complacency tax, not loyalty tax.
Yeah.
Now, the other thing, I just want to pick up on something that Kate said, because Kate mentioned the knowledge with refinances. And of course, they've been around the block. They know how it works. They know it's not as scary as all that and that they can do it and they can save themselves a lot of money. That's one difference. The other difference between refinances and the rest of the market is that time is on their side. The clock isn't ticking towards a settlement. They're not, the fear of missing out hasn't hit them hard between the eyes. So they have time actually to negotiate and not take the best deal with great relief and mop the brow and say, oh, thank gosh for that. We can actually get in and settle and buy our house. They don't have that pressure on them. Time is on their side, not the provider's side. So the first offer is probably not going to have to be the offer that they accept. So if they're thrown a bone by their existing borrower, their existing lender, they should be going to another lender and say, well, you know, can we do better than this? And they probably will get an answer that says, well, yeah. And they'll start up their own little auction. So time is on their side and they've got to use it.
Yeah, and I think that also lending operations and processes and experiences have gotten so much better over the last few years, to Nathan's point, that there really isn't that level of friction. And I think everyone has a poor mortgage story if they took out their mortgage in the last sort of 5 years or more. But I think there are less and less of those instances. There are some really slick processes that are there to help customers. And I think even 2021 and ongoing will prove to be even more interesting as we sort of start having more consumer data right opportunities coming to the fore through for mortgage lenders and for consumers as well. So moving on to the next sort of topic that I wanted to discuss, and Nathan, you sort of brought it up. There are some things that have started to trickle through in the market that are new practices within lending, and I guess new practices from the case of marketing and being very overt. And LVR pricing is one of those things that we find very unique in RFI Group's data, and we'll ask Kate in terms of what she's seen as well. But the LVR pricing, how do you find that as being how is that a big advantage for Athena in terms of how you look at customers and how you communicate with customers, and what are the benefits and pieces of feedback that you've had from customers on that?
Yeah, so probably what we should start off by saying is the idea of different tiers based on LVR at origination is not new, right? Those sort of structures have been around for quite some time. But what is new is the idea that it's a dynamic structure that as you pay down your loan, you're not locked into the LVR you were on day one. You get the benefit of that flowing through. And so that's a unique product for Australia. And in fact, we've actually been in discussions around just is that being done anywhere before? And so for us, that is it's basically looking at LVR every day for a customer, and as you pay down that loan, there are those opportunities you start to get yourself down into those lower tiers. So we've had the idea as you become a better driver, you get a no claim bonus in your insurance, or as you improve in many other products. That concept is very, very, very common. It is sort of a new story in the mortgage market. We've had really strong reactions from customers here, because I think it does accentuate the idea that I've become a better customer, and whether it's loyalty tax or the cost of complacency, I've been taken advantage of, right? I've become a lower risk and more attractive customer, but that benefit has gone completely to my legacy lender rather than to myself. The part of it that we find particularly powerful is the behavioural economics component of this. And so when you talk to consumers, the idea of I would love to pay my loan down faster is an incredibly strong and powerful feature coming back from all our consumer research. when you talk to someone when they first bought a property for the first time, incredible excitement at, the achievement of saving that deposit and getting a house. But talk to them just a couple of years later and language like, oh, it's like a face tattoo. It's something I got when I was young and I'm just going to live with that for the rest of my life. And so the challenge is always, how do you maintain someone's motivations over a 25 or a 30-year period, right? That's a long time to maintain the rage of how do I take action? And so the LVR-based pricing is interesting because if you started at an 80% LVR and just made those minimum monthly payments, it would be just a bit under 4.5 years that you would be sitting down into the 70% range. And then again, just another 4 years or so and you'd be at, at a below 60% LVR. So you would go down and be benefiting that over fairly near term. But the behavioral economics view there is, but actually, if you could just find that extra $20, $30, $40 in a month and just make some payments over and above, that's that real opportunity to accelerate your path down into those to those better tiers, save big dollars, cut years of the life of your loan. And so just getting that much more immediate feedback than having to wait till the end of that 25-year period to really realize the benefits of all the hard work. So we've been really excited by how customers have reacted to that. We've been really excited at the sort of the behaviors that have come through, and it's really just part of our broader commitment for how do we help Aussies pay down the home loan faster? And the thing we would call out is this is a major macroeconomic issue in Australia. You sort of look back to the early 90s, household debt to GDP in Australia was actually one of the below average amongst the developed nations. And actually, but fast forward to today, and it's actually one of the higher the higher rates in the world. So it's not that people can't afford the interest. I mean, rates are very low and people can afford the interest payments, but they're about a decade slower than a generation ago in paying off the loan. Housing is expensive, mortgages end up being a lot bigger, and then people are slower in paying those off. And so things that we can do to actually help people really build a much more positive relationship with their money, to make sure you've got great rates that stay great, so don't have that loyalty tax, but then also recognise as they become a better borrower over time and allow them to benefit from that. That's where we can think about a really a much more consumer-centred focus for how we actually help people finance a home.
Excellent. And Kate, you've seen LVR pricing play out in the mortgages data for the last 12 months, and it certainly seems to be emerging as one of those things that mortgage customers are increasingly more aware of. But how have you seen that move from a motivator to approach a specific lender?
Yeah, I think the first point I'd make, and we've spoken a bit about front book, back book pricing, customers are aware that happens. They might not know the exact rate that they are missing out on, but they definitely know that a newer customer is getting a better deal than them. So we've seen that coming through in our data as a key pain point. It's one of the reasons why customers switch as well. So that idea of I'm not being rewarded by staying here is a key driver of switching. And then if we look at something like LVR pricing, so what we've been looking at, and this probably predates actually the Accelerate loan being in market, but we were looking at the extent to which customers are looking for different types of value from their lender the longer that they stay there. And when the customers knew what they're really looking for is a good competitive rate, they're looking for being rewarded based on their relationship with the lender in terms of things like number of products that they hold. But as they get further along, and once they hit that 2-3 year, 4 year mark, that's when they're looking for a reward based on tenure. So reward me for sticking with you, reward me for my loyalty to you. Don't reward or don't give a newer customer a better deal than me when I'm the one who's stuck with you. So that's something that's been there in the data. I think it's probably been there even longer than we've been looking at it. And to me, the Accelerate loan kind of fits in with that mindset. And I really like it as well in terms of rewarding good customer behavior. We get asked a lot about incentives at RFI, and incentives work, right? So if we look at something like cashback, it's incentivizing acquisition, and it gets used because it works. It incentivizes customers to choose one lender over another, but it doesn't necessarily incentivize long-term loyalty. I think something like tiered LVR pricing, probably does. It gives customers a bit of a sense of I'm getting rewarded for doing the right thing in terms of behavior, but I'm getting rewarded for sticking with you as well. So when we look at incentives that have worked really well, not just in mortgages, but in other parts of the market as well, it's where they reward the right type of customer behavior, and loyal customer behavior, I think, is what should be rewarded and leads to longer term stickier customers. If you're just rewarding acquisition, to an extent you're buying market share, and those customers will switch and go somewhere else for another for another acquisition incentive. So they're not necessarily going to stick around forever. There'll always be a proportion who will then move on again. So I quite like LVR pricing. I think we might see more of it in the market. I'll be interested to see what happens, but I quite like it as an incentive. I think it probably makes a bit more sense longer term than something like cashback.
Yeah, and certainly seeing more overt marketing and propositions relating to it. I think that's certainly a good prediction for the coming years. But going back to sort of cashback's influence, it seemed to be like a bit of a meat raffle for a little while with all the increased cashback going on. And Stephen, that would have really, again, you would have seen some interesting insights. I mean, cashback for some lenders had to be a ticket to play. For some, it doesn't, because their rates and their products are very good. But in your view, did you see it as a ticket to play, sort of at the start of, or when was it, sort of October, November, that it really was kicking off, or maybe even earlier?
Yeah, I look at cashback and always think, well, check the underlying rate, and that's the issue. You're still got to check the underlying rate. That makes a big difference. So cashback typically will pay 1 month, 1.5 months worth of repayment, and then you've got 30 years, but 359 more repayments to make. So don't just get sucked into cashback, obviously. I think cashback is here to stay. In particular, well, the refinance market is where it works. And it goes to the time point that I was making before. Refinancers have the luxury of being able to choose the time when they want to do this. Buyers don't. So given that you can choose the time, how do providers, how do lenders actually shake the tree and get the apple to fall? And cashback's a great way to do that, to promise people that they can have $4,000 in their pocket if they refinance this way. And you know, we've covered the hassle, we've covered the cost. So I think it's here to stay. I want to relate it to LVR as well, though, because I also see LVR pricing becoming bigger and bigger, but I think that's sort of like pricing for risk on training wheels, because with open banking, we've got a lot more information coming through. So we'll be pricing much more for risk going forward, and there'll be a lot of opacity in the market because people will be paying all sorts of different prices based on broader measures of risk. So I think they'll be doing that. And so we'll be pricing much more for risk. I think we'll be using cashback the same way. We'll be using cashback for low risk, low LVR customers, if you like. Cashback for low risk customers will be here for a long, long time, because that's the sort of customers that people want to attract.
I think cashback's a differentiator as well, right? So if you've got in an increasingly competitive environment, a customer's looking at two loans which look the same, and we spoke about customers not necessarily understanding headline rate versus comparison rate. The difference of one lender offering $4,000 and one not is enough to drive a customer to choose a lender, I think.
Particularly if for a segment of customers who can assign weights the value of the $4,000 higher than the fact they'll be paying $40,000 more in interest, but that just requires you to have some you know, more complex math and all the rest, right? So I think there's always going to be a segment that the money, you know, the drug of the cashback. I think the comment earlier, well, I wouldn't worry about 0.3%. Well, but of course, 0.3% over 30 years, you know, on a typical mortgage, that's a lot more than $4,000, right? And so unfortunately, that the heuristics of how people make these decisions is not always working to a customer's advantage. Clearly different if it's a like-for-like proposition, but often what it really is trying to do is cover up the fact that this is actually an expensive loan, and this is the shiny object wave to try to disguise that fact.
I think mentally they're already spending that $4,000 on a brand new 85-inch TV or something like that. And then I guess the last topic I wanted to cover off is loyalty, and we've touched on loyalty in a variety of different ways. I think that it's interesting to see that, I guess, changes in customer loyalty, customers being more open to holding their mortgage outside of their main financial institution relationships. But what are some of the other practices that, or some of the other key behaviours that you think will develop over the next 12 to 18 months that are going to be sort of increasing linchpins in terms of maintaining that loyalty on that mortgage? Will it be extra tools to help you pay down? Will it be, I guess, other product evolutions that turn into more transaction account behaviour or more partnerships? What are your predictions, Nathan, for the next 12 to 18 months?
Yeah, it's a big topic. Interesting when you look to the NPS scores of major mortgage lenders, and in many cases they're negative and often negative by quite some amount. So what does that mean? The number of advocates who think, wow, I've got this great experience, versus the number of detractors who are basically really not feeling like this is a product that they would recommend to others. It is, loyalty in the context where your detractors are outnumbering your advocates by, in many cases, quite substantial margins is a challenge. And so I think it just comes back to, does the customer think you are on their side? You've got goals for what you're trying to achieve out of this loan. And, whether it's savings or whether it's service or whether it's the simplicity of the processes, are you doing things that actually help, customer achieve those goals? And I think the simple answer is most customers don't feel that about their lender today. Part of that is all of the conversation we were having about the front book, back book, and the idea that I'm loyal to you, you're not being loyal back. Part of that is just the service experience just has so many challenges and breakpoints. And so again, care enough to give good service. And what do you do when things go wrong to show that you're gonna fix it? But I do agree that, Julien, some of the points you're asking, there are opportunities around innovation on many dimensions. So a world where it becomes easier and easier to manage your mortgage separate from your main banking relationship, because you have real-time payments to move money back and forth, because things like open banking do make it easy to still get a very holistic view right across your financial wallet. I think we are going to move into a world for many parts of people's financial lives. They are going to pick specialized verticals that really have solutions that offer, the value, innovation, service, and frankly, just caring more about customers. And this becomes a product. Mortgages are a product where that's the case. We should call it that probably isn't new. I mean, when you sort of look to the history from sort of the early 90s right up to the GFC, when you had, Aussie Johns and Rams and all the rest, you got very large part of the mortgage market moving from bank to, non-bank channels over that period of time. And that sort of switch happening at huge scale in a way that you never really saw for many other personal financial products, which are much, much higher inertia. And so, the quip that people make where you're more likely to change spouse than change bank is actually true for transaction banks and, many of those other modes, but it's definitely not true for a mortgage, right? People know, this is tens of thousands of dollars. It's my main, my main financial expense. If I am willing to actually work with someone here, that makes a material difference to, can I afford to send my kids to that school? That's the argument that I won't need to have with my spouse worrying about money. That's financial security in the future. And so these are really big things. And so coming back, I think loyalty translates into, how do you have confidence that when I get a great rate on day one, my rate is going to stay great? That, this is a product that can actually meet my needs as they evolve over time, and that you're going to treat me as more than a number and give me great service, throughout that journey. I really do think those are the critical components, but I do agree that there are things like building more transactional capabilities back into your mortgage product. I mean, for many consumers, why do you need a transaction bank account at all if you have, the payments capability, salary and crediting, all of those components into your mortgage, right? So rather than having money sitting getting no interest, having that do the work of offsetting against the mortgage balance. And so I think there are lots of opportunities to really challenge some of these industry conventions and say, how do we actually have a home loan industry that just serves customer and community much, much better? And that then translates into, much longer term opportunity to build longer term loyalty as well.
Excellent. And I think that with, I guess, our audience today is a room full of home lending professionals. So I'm sure they're they're writing down some ideas for their shopping list to take to their managers for development, and that will certainly keep you busy, Stephen. What are your predictions? There are obviously a variety of things that you'll keep track of in terms of mortgage products that are out there in the marketplace. But what are you seeing as some key things that you'll be needing to look at from a platform perspective, and what your clients are offering?
Just to think about the refinancer market at the moment, and where refinancers sit and where they will sit over the next couple of years. Refinancers have a repayment record. Open banking will make that very obvious and very clear. They can access their comprehensive credit report. They can visit comparison sites like CANSTAR and see virtually the whole market displayed, and see where prices are. I think it's optimistic of lenders today to believe that consumers are not going to cherry pick. Consumers that are a great credit risk are going to cherry pick. They won't believe that they have to have all of their eggs in one basket at one bank anymore, because their online banking and their personal finance manager products are going to make it feel as if they all are together anyway. So frankly, I think people will cherry pick, and the big profit earner in financial services is home loans, and that's the one where there'll be more and more opportunity to cherry pick. So I think that's the sort of behaviour we're going to see from consumers over the coming sort of few years. Now, in terms of providing value to consumers, there are really two core things here. One is that there's a great price, so the fees and the interest rates are a good price, and as Nathan points out, you're not finding yourself in a situation down the track where you're paying a heck of a lot more than people who are new to the business. That's critical, and that goes to the brand value you're offering. So price is one big thing, and the consistency of price is what that's about. So that's one thing. The second thing is, how else do you save money? Well, it's by managing what you're doing better. So if you can embed your other finances to really use them effectively to cut the cost of your funds, so it's offset and redraw currently, but there may be other models going down the track. That's what you must do. And then I think you engage customers by talking to them all the time about how they can actually get ahead. You can get ahead by putting this much more in, by making fortnightly rather than monthly payments, by et cetera, by engaging people all constantly about those sort of things, so that you're on their side. Frankly, you're wanting to help them save money, and your proposition does it for them. Excellent.
And a big part of that will be developing a process and a system that kind of like on a nice car, when you close the door, it has a reassuring thunk. When you're taking that leap of faith with CDR and sort of handing over your data to other parties. And Kate, I'll throw to you to finish off this topic. There are some interesting things that need to happen when customers are embarking on some of these new experiences, and you're a pioneer at RFI. I know that with CDR, you've taken the leap of faith. What are some of those reassuring thunks or clunks that need to happen?
Thanks for calling me a pioneer. Yeah, I have used CDR, which is quite exciting. Not exciting to my friends and family, but it's definitely exciting to the people I work with at RFI. I would echo what Nathan and Steve were saying as well, just around how you do drive loyalty with customers. I think if we were having this conversation a few years ago, we'd be talking about deepening the customer relationship and winning main bank, and increasingly I think that's not as important to have, and increasingly customers don't need to have all their banking in one place, and CDR and open banking definitely change that dynamic as well. What is really important is trust. And Nathan sort of alluded to this, talking about doing the right thing by customers. So when we talk about what trust means, it is having my best interests at heart. It's keeping my data secure, keeping my money secure, and increasingly that keeping my data secure piece will become more important. When we're talking about CDR, I think there's a number of elements that's important to get that experience right. And I think there's examples from the UK of where maybe hasn't been the best experience for customers, but the experience that I had was pretty good. So making sure that customers feel like that there is security there, that there is accountability, that they have control, I think is the other real key one. And we see this coming through in our data all the time. Customers want control. They want control of their finances. They want control of their money. Any tools and features that lenders can develop that give customers that sense of being in control, I think is really important, and that helps to build trust. And ultimately, customers will be, while they are price driven, while they do still care about other elements, winning customer trust is still really key. So making sure that customers feel like you have their best interests at heart, they're making the right decision by you, and they're able to sort of get the best out of their money and get the best out of their finances. I think that will be increasingly important going forward.
Excellent. Yeah, it seems like that. Yeah, financial wellness is most important when it comes to looking at your mortgage as well, as not just your savings and transactions. And we certainly see that all these sorts of tools that are being rolled out certainly sit the majority of the time within the domain of savings and everyday banking teams. But given that it is going to be the biggest chunk of debt that the majority of people will ever take out, you'd hope so, yeah, understanding more about it, how can you get the best out of it, how can you be more financially responsible with it, and be more aware of newer opportunities, that's going to be an interesting place where we might see the market evolve, and it'll either be done by the newer lenders, or it might be done by, I guess, some of the more incumbent lenders, but we'll just have to wait and see how that all pans out. But look, thank you very much for your time. Nathan, thank you very much for joining us. Stephen, thank you very much for joining us. And Kate, thank you very much for joining us. And looking forward to the rest of the conference. Thank you very much.